This is John Shelley with the Traders Country Club, and this is our video of the day. Here's what we're taking a look at. Last week, we had in the Nasdaq a high above the high of the prior week, a low below the low of the prior week, and a close for the week that was below the low of the prior week. Many years ago, this used to be called a key reversal, a bearish key reversal. Now, many people are going to be talking about this and focusing about this potential bearish signal. The beauty of TradeStation, and this is a TradeStation chart, is that we can actually back test what the market tends to do when you've had a week such as this. If you go back in the last 15 to 20 years, what did the market tend to do when you had such a pattern as this? Let me show you a few examples. Now, before I do that, I'm going to show you here, we're going to go short in our back testing, because if we get this bearish key reversal, then the implication is that we need to go short. So we are going to get our TradeStation to go short when we have such a pattern. Let me show you a few historical events so you know where we take profits and where we put a stop loss for such a trade. Here I'm showing you IBM. Now, we had a similar price event occur in November. This high was the high of at least the last 26 weeks, which is part of our test to make sure we have a bull market in our test. High above the prior week, low below the prior week, low, close below that low. We're going to go short. Now, how do we test this? We're going to put a profit target at one average true range below where we go short. That's where we're going to take profits. We're going to put a stop loss one average true range above this sell price or the close of this week. In other words, what does the market tend to do after we've had such a price pattern? Does it tend to go down by one average true range after such a price pattern, or does it tend to go up after this price pattern? Let me just show you what happened in this particular event. Here we had this key reversal, and yet you can see what happened. The market did not go down in this instance. It went up. This position, if you had gone short, basis the price pattern of a key reversal, you lost money. Let's just scroll back a bit here. Let's go back in time. Here's another event. Nice big key reversal. Stop loss. The market didn't go down. It tended to go up. The bullish trend was still very, very strong. Let's go back some more. Let's see. Now, here's a winning trade. Key reversal. High of at least the last 26 weeks. This time it went down by one average true range, so you would have made a profit. I'm going to show you in just a bit another one. Here is a big reversal, losing trade. Let's go back. Another one, winning trade. Here I'm showing you, I've tested both positive and negative. This was a bullish key reversal. High above the high of the prior week, low below the low of the prior week, close above the high of the prior week. Go long. In this instance, it was a winning trade. The market went up by one ATR to reach a profit objective. Now, when you backtest, we go back up, and I'm going to show you some results for the last 15 years. Let's not look at one single event or two. We need to look at just what does the market tend to do with a large sample size, so we get some clue as to whether or not we should actually go short right now in the Nasdaq solely because of a key reversal pattern. Now, what I'm showing you here is the statistics if you ran bullish key reversals and bearish key reversals. First thing, notice this. This is the quadruple Q's last 14 years. Notice how rare this price event occurs, which is why we're going to have to backtest many different stocks, and I'm even going to throw in a few commodities here. We've only had one time where we had a key reversal on the long side on a weekly chart. In this particular case, it worked. The bearish reversal that we've gotten this week, this is the first time we've had such a pattern in the quadruple Q's in 14 years. Now you can look at this. This isn't enough data. in order to make any forecast whatsoever. For statisticians, this is no sample size that we can make any conclusions. We're going to have to do a lot more tests. Let's take another look at that IBM. Here we're now getting a little more data. Now this column right here is the long trades. In other words, this is the times that you have bought on a bullish key reversal. Here is the short trades. This is when you would have sold short the bearish key reversals. Notice the percentage, 50%. In other words, it was a coin flip of whether or not the market went down 1 ATR or up 1 ATR. That was no way to make any money, was it? Here we're taking a look at Apple. Notice again we have 2 winning trades on the long side, 100%. 4 trades total, and yet only 1 out of 4 won on the bearish side. Now I'm going to explain some of this data in just a bit, but what we're seeing here is that the bearish key reversal so far is not at all a trade that you can routinely make on a systematic basis. You cannot make a forecast basis that price pattern alone. Here you're taking a look at General Electric. Here you at least 3 winning trades out of 1. Notice the long side again positive. Here's Microsoft data for the last 14 years. And finally, you're getting some, I'm showing you the data of ExxonMobil. Now let me explain a little bit why there is a bullish bias of a bullish key reversal, why they have been positive. Let me ask you, in the last 14 years, what is the general bullish bias been? And you say, well, John, it's been positive. That's right. If you go back 14 years, except for the last, the 2 major declines, most of the time in the last 14 years, the market has tended to move up. That is going to push a bullish buying bias on any statistical run that you make. So when we were showing you these 100% gainers on a weekly bullish reversal, that is primarily the reason. Is because the data set that we were backtesting on had a bullish bias set in the data. So just understand that when you take a look at price patterns. So let's review where we are basis what we're finding out. We have a bearish key reversal on the quadruple Qs, the Nasdaq 100. Basis history, the market may move lower or it may move higher basis this price pattern alone. Basis history, you cannot make a confident bet that the market will go and fall by 1 ATR based upon this price pattern alone. The market very well may move lower, but it won't be because of this key reversal. It will be because of other factors. My belief is that it may very well fall because the bull market is 6 months old from the last time we've had a major correction. We are due, in regards to a cycle basis, a deeper correction. So in this particular case, the bearish key reversal is a little more added evidence, but it is certainly not definitive. This is John Sheely, the Traders Country Club.